It's already 9:32, so let's get started. So welcome everyone. Good morning, good evening. We are privileged today to have two eminent speakers with us, each an expert in their respective field. First, half an hour, we'll have Ashwini Pansiji, who will lead an interactive session on de-risking. Ashwini ji brings her own unique insights and expertise to this topic. She'll also briefly introduce herself and provide us with glimpse into her professional journey. Following that, we'll have another half an hour session with Prafulla Nabarji, who will delve into intricacies of economics. Prafulla ji is a distinguished figure in financial services, boasting over 20 years of experience with a focus on fixed income and equities. He's a master in developing quantitative valuation models and has a rich professional history that spans across US and Europe. Underpinned by a PhD in finance, Prafullaji Insights promises to be both enlightening and invaluable. So please join me in warmly welcoming Ashwini ji and Prafulla ji as we look forward to this session filled with in-depth knowledge and engaging discussions. So over to you, Ashwini ji.
Yeah, and just a very brief introduction from me. I've been, I'm a chartered accountant by background, and started my professional journey with Pricewaterhouse many years ago, and then eventually moved into the United States. I think it was 2002 when I moved here. And currently I work with a company called Intercontinental Exchange. They've got operations, across the globe. They operate in 3 different segments. You've got the exchange and clearing segment, and then you've got the data segment, and then you've got the mortgage segment. So what I do with them is really, I'm a part of enterprise risk. And what does that mean? So enterprise risk is really interesting in terms of, we want to make sure that whatever corporate objectives we have, for whichever, segment that ICE operates in, we determine what the various obstacles that we could face, right? And then how we could either, accept that risk or you mitigate that risk. And given that, we typically look at multiple different risk areas, right? You look at operational risk, you look at legal risk, you look at business risk, strategic risk. So competition, we look at many different aspects. One of the cool things we do every year is we look at, every company when it goes public and has gone IPO, they, basically publish what they call as a 10K. And as a part of that SEC filing, one of the things that every company lists is, here are all the risks, here are all the things that could possibly go wrong. We're required to disclose that. And, whether it's the regulatory environment, whether it's competition, whether it's, technology risk, whatever it is, we're required to basically, describe all of them, what that risk could be, such that when an investor or when the public sees that, they understand, the risk environment or the operating environment that our company operates in. It enables them to, every quarter we have an earnings release call. And the purpose of that call is for our senior management to basically describe, how we grow from quarter over quarter, what we've accomplished quarter over quarter. And then it's an opportunity for the investors to come out there and ask tough questions. But essentially, that documents meant to be, released such that, our investors have an opportunity to look at, all the details, and then, it's a tool for them to kind of determine whether they want to invest or not. So, in the same light, obviously, I know we're discussing the topic of de-risking. So if you don't mind, I'll just jump into it right away. We are all kinds of horror stories of startups failing, and obviously the statistics as we know them, they're harrowing. Is it right that possibly more than half of the startups usually don't last more than 5 years? 90% of them fail. So the process of de-risking, if I may say, what does it involve? It's basically a very careful identification and then mitigation of your potential obstacles, whether it's uncertainties, challenges that could prevent you from tapping into potential investors, that could prevent you from going into the market, that could prevent you from growing, or that could prevent you from even surviving. So from a startup perspective, de-risking, obviously not only it will reduce your potential pitfalls, but also it significantly boosts investor. If you do go outside and seek investment, then it boosts your investor confidence, increases your startup appeal, and you by going through that thought process, you're basically demonstrating to your investors that your startup is a judicious or a prudent investment choice, characterized by minimized risks, if I may say so. So, you can only present a clear, I think a more predictable, a more compelling investment proposition to potential investors when they see that, you've identified, addressed, eliminated your key challenges and unknown factors. And then, they are obviously more likely than to believe in your vision. Also, de-risking, what does it do? It demonstrates your competence, it demonstrates your preparedness, it demonstrates your commitment, to transparency and responsible business management. Investors are more likely to trust your ability to handle challenges, whatever they may be. In the future, again, you just have a more stronger, I would say, relationship and partnership, and it's really a trust building process. So I think a couple other things that de-risking typically help is, one, your likelihood of your startup surviving and flourishing in a competitive market, there's a higher likelihood of that. When you have thought through all the scenarios, trust me, you're better prepared to weather, whether it's economic downturns, whether it's market fluctuations, unforeseen challenges, and very, very critical exercise, just for your overall long-term success. You also, I think when you think through all of this, you're developing also by definition and by doing so a thorough understanding of, all your market dynamics. And potentially by doing that, you may have also gained a strategic advantage over your competitors who may not have taken such measures. So, again, a lot of this is, to me, common sense. But if we can maybe just go through, some of the risks, right, that entrepreneurs face in a startup journey. The first one I would say is product risk. And just not knowing what your product does. I think it seems very, how can you not know, what your product is? It may seem very counterintuitive, but there are many startups who haven't fully answered the question of, what is the product that they are selling. It's very easy to, generally sell, I'm selling a product, but then, what problem does it solve? How does it work? Why would someone buy it? What makes it special? How will you sell it? There's always, you have to make sure that you are able to answer those questions. And then, I think, push them as a part of your sales pitch, if you may, to whoever it is, your investors, your clients, your customers, whatever you want to call it, your partners. So, I think it's important for, startups to just learn what their product is doing and what it is for. I think the second piece that, there's market risk, right? So market risk is, again, just uncertainty surrounding, your customer demand and market conditions. Will your product or service find a market fit? Will customers buy what you offer? And if they buy now, would they continue to do so in the long run? Just having an ideal customer in mind, I think, is important aspect to consider. And if you don't know what it is, I think it's important to kind of start out by finding, what that market is. You have to know your market. And I think understanding the local dynamics, your consumer behavior, your competition, you can validate a lot of that through surveys. You can use focus groups, you can use pilot tests. So some of that will help you shape the identity of just your company and in the process, your product as well. Quality. I think product quality risk is obviously important. I think once you know what your product is, who your ideal customer is, I think it's really important to build a reputation for a high quality product or service. Beginner startup is risking a lot. I think if they have an idea, which is why I think it's important to kind of either prototype or if you've had a previous startup experience, then that usually helps, because investors and clients will have more faith in you. But I think a lot of times product quality gets compromised, and I think that could very quickly kind of see a downside. I think a lot of people, I've heard sometimes people say that, well, I only have to be a little bit better than my competitor. And I think that's probably not the right attitude. I think you just have to strive for the best you can offer. And typically your customer will tell you what they're looking. Typically you'll know if you've built a good product, if you've solved the problem, if you've satisfied the customer, and then if it's fit for the purpose. Then I think typically, obviously, you've got the team risk, finding the right team. Just having the right team is so essential. Who you have to do so many things. You have to run the business, you have to hire, you have to teach, whatever it is. I think having the right partner is always important. And then I think having someone who shares your vision, and they'll be able to help lead the way when it comes to developing your product, market fit, recruiting the rest of your team. So it's really important to cover your bases with that respect. So again, I think it's important to invest in team development, and then your positive work culture. Often we start off building a startup and then realize, oh, I don't have the right help. And you have a forum like Garze Marathi, and I'm sure there are other forums where you can get help from investors, or you can get help from people who've done this before. But I think seeking as much mentorship and advice, connecting with experienced entrepreneurs, mentors, industry experts who can provide appropriate guidance and insight, I think that's only going to be valuable. A lot of people don't think ahead in terms of strategic partner. Where are you going to source from? Who are you going to distribute? How are you going to distribute it? Having that, establishing key partnership is really critical. How you collaborate with your suppliers, distributors. I think it's only going to enhance your startup's capabilities if you think through that. And it can also provide you with additional resources, or avenues to and access to new markets, and expertise. So I think that partnership risk is important to consider as well. I think the absolute critical one is competition. I think typically you face brutal competition from like established players in the industry, and that can be really daunting, and failure to differentiate your offering, obviously can lead to loss and death of a startup. So just analyzing your competition to identify, your gaps in the market or opportunities to differentiate a product or service, evaluating what your competitors doing well, evaluating what your competitors not doing well. It can only help you position your startup effectively. So, from a perspective of how I think it's important to understand how you're going to acquire your customers, but it's also important to have a solid plan and determine how you're going to retain them for a really long time. So building a strong brand and a reputation, will always help you. I think it's important to invest in, reputation management and branding, and, from absolutely the start and the outset. You're only going to gain customer trust if you do that. The other piece that I feel is you have to be able to demonstrate to your investors that you'll be able to sell your product effectively. So you may want to consider people with sales experience to your team. And, once you've identified who your ideal customer is, then you have to, I guess, find, ways to retain them. So that's going to be important. I think staying agile and open to change, continuously learning from your experiences, seeking feedback. And then I think the most important is sometimes willing to pivot where necessary. If you're going in a certain direction, but it doesn't make sense anymore, I think you should be agile enough to be able to pivot when you need to. There's always infringement risk. Again, if you have something unique, you definitely want to go all the way to protect, whether it's through patents, trademarks, or copyrights. I think very critical to know what your regulatory compliance and legal risks are. Just navigating, complex regulations and compliance requirements obviously can take time, especially if you're in a heavily regulated industry. But if you don't comply, you're going to end up paying fines and get into legal trouble and reputational damage. So just staying informed about your regulations and compliance requirements in your industry, your standards, I think is really critical. Making sure you have a really good legal counsel, if necessary, and implement any robust compliance procedures to avoid any legal troubles. I think consulting an attorney is always helpful. Choosing the right business structure, what are the laws that may impact your company's growth, or what copyright. So you definitely what you don't want to do is hire an attorney too late in the game. So that's something you want to do right away. Not enough money, I think financial is always, if your idea is excellent, you need money to start, whether it's friends, family, but I think financial risk is the most significant concern, I would say, for startups. And, most entrepreneurs do need help to secure that funding. So I think it's important to identify what those key business milestones are and schedules are. You may have money right now, but I think as you reach those milestones and schedules, additional investment may be necessary to basically reach your next major milestone. So just, I think, identifying how you're going to finance a lot of your product development and growth is obviously critical. I think technology risk in today's digital age, it's a core of most of the startups. It includes issues with product development, whether it's cybersecurity, staying ahead of technological, advancements. So that's really critical, just to focus on your technological preparedness, and invest in infrastructure, technological infrastructure that supports your business needs and your growth, and provides robust, cybersecurity measures. So that's, I think the last couple of things that I want to say is, even the best of the business ideas, fail sometimes if you don't have the right execution. So that, managing operations, delivering on promises, scaling efficiently, these are all very, very critical components of successful execution. So it's really critical that, we set clear milestones and objectives, and then, figure out ways to monitor progress, and, how you adapt to change. Key metrics usually are a good way to track and analyze, your key performance indicators, if I may say so, and just identifying any trends and areas for improvement. I think data-driven decision-making will always help to make very, informed choices. And the last one that I want to say is, you know, it's always a good idea to build an all-weather company. You know, so diversifying your revenue streams. You know, you really want to avoid over-reliance on one customer or over-reliance on one product or over-reliance on one revenue source. So as much as you can diversify your revenue streams to mitigate, you know, whether it's a sudden market shift or a downturn, you know, I think that's always going to be, you know, very, very critical. I'll just maybe stop, and you know, I'll kind of just you know, the company that I work for, which is ICE, right? I mean, the reason we didn't start, you know, our founder Jeff Sprecher started the company back in you know, 2001, and we started with really only the exchange segment, not even clearing. We were only an exchange. You know, there wasn't a venue where you know, electronic trading existed at the time. So we started with building a platform where we facilitated electronic trading, you know, and that was the only product, you know, that were our products are our technology platforms. But eventually over time, you know, it's interesting because trading is a business, as you know. When economy is going down, people trade. When economy is going up, people trade. You know, volume drives up business, and we saw volume growth, you know, when we had pandemic, and when we saw volume growth when, you know, Russia invaded Ukraine, and we saw volume growth when we saw regional banking crisis in the United States. So you know, we've sort of built a all-weather company. You know, we bought the New York Stock Exchange, you know, so sometime in 2013, 2014. You know, we invested in data as a business, so we're direct competitors of, you know, if you may say Bloomberg or Refinitiv. You know, we are in the benchmarking business of, you know, LIBOR. You know, we more recently started, you know, the mortgage business. And it's interesting because when I look at all of my segments, not everything's growing at the same rate. But if a particular, so for instance, you know, if I may, I think this is all public news, but, you know, LIBOR has, you know, competition. There are other benchmarking products available today. And you know, maybe LIBOR is not being used as much, but, you know, overall, does it really impact, you know, my company as a whole? It's a very small dent. And you know, the other piece is, you know, mortgage. If we relied heavily on mortgage right now with the interest rates going up, you know, the amount of the volume of how much home buying is going on right now and how much home refinancing is going on right now, we wouldn't be making as much money. But you know, it's a really nice you know, product cycle that we've built. So I think I feel like it's paid off, you know, spending time in kind of investing, whether it's through M&A or whether it's organically growing and, you know, building products. I think in the long term always pays off, you know, in thinking about how you diversify your revenue stream and your customer base. With that, you know, I'll just stop because I know I'm hitting that 10 o'clock mark. But, you know, I'd love to, if anyone has any questions or any thoughts, or, you know, my everyday is always based on thinking about, you know, we have a business in, you know, India, Singapore, London, Chicago, New York, Atlanta, California, Houston, and you know, so we are always looking at, you know, how not to be over reliant on a particular region. So for instance, we have an operation in Tel Aviv, and you know, I think we did a very recent analysis on there are some key personnel with very key you know, skills in that region, and what if things go down and, you don't have that employee base anymore, or they're not able to work anymore? Can you operate from another region? Can you operate from, so we do think about, cross training a lot. We do think about many different things to de-risk our operations. So it's probably the least thought about element, if I may say so, but the most important element that any company, whether you are starting off or whether you're at the peak of your growth, I think you will not waste your time and resources and energy, just putting in some thought on that de-risking topic. I'll just stop here. Thank you. Any questions or any comments or any thoughts?
If you have any questions, you can post it on the chat here, or you can raise your hands. Any questions from anyone?
You'll have to read them to me, Dev, if
Sure.
anyone.
All right.
Hi, Ashwini. This is Sanjay.
Yeah. Hi, Sanjay.
Hi. So as a startup, there are like multiple things involved, and either product market fit is one of the risks, or even finances coming in can be the risks involved. So my question was more of mitigating it. Basically, identifying is one part of it always, but how do we mitigate, or how do we mitigate particularly product market fit in case if there is a certain assumptions that is being taken initially based on the market feedback, and market
Yeah.
shakes, or that fit doesn't happen. We were assuming that we'll be able to sell in this market, but no, it doesn't happen. So is there anything that you can put a light on that? How do we put a mitigation plan?
I'll just be honest here, but one, I'm not an entrepreneur, just to say that, but at the end, but still, I mean, I think one of the key pieces that I think we try to fit the market. It's like, okay, I just want to build something and sell something and make money.
Sure.
And I have a number of friends who've been very successful at their businesses. I think one of the things that they've done really, really well is they've addressed the pain point.
Yeah.
I think if you're addressing a pain point, what is that? What you don't do you want a vitamin or a painkiller? We always look at that that way, and I think if you are mitigating their pain point, I think you've got the market. A lot of startups, I feel they try to fit it rather than solve the problem, and then I think end up kind of not peaking. So I would really rethink some of that strategy in terms of what is your product really doing. Because I think you don't have to think about a lot of other things if you've got a really good product. And I think a lot of people don't think about it that way.
Great.
Yeah. Thank you. Thank you, Ashwini.
Thank you, Ashwini, for sharing your knowledge on this topic. So in interest of time, let's move on to the next session. We have Prafullaji who will be talking about economics. And if you have more questions on de-risking, please put it on chat, and then we'll get it answered from Ashwini ji offline. All right. Thank you. Prafullaji, you can start sharing.
Can you see my video or?
Yeah, we can see your video screen.
You can see. So this is sort of a short case that I had developed for introducing the concept of unit cost as well as financial statements.
Prafullaji, if you're sharing your screen, we cannot see it yet.
Yes, I am going to share it in a
Okay.
second.
Okay, perfect.
So basically, it's from what basic information I received, I thought that some of you may be fairly well along and some not so. So it is kind of uh, directed at the average, but hopefully it illustrates the concept of unit cost and how to determine it and how to use that information. And finally, how to build financial statement for us business that is just starting up. So with that, let me just go and share my screen, and please tell me if uh, you can see it.
Yes, we can see it.
Okay, so this case, it is just less than 2 pages, and it should have been shared with you. So hopefully you have had a chance to at least glance through it. But essentially it is about, it was developed for Garje Marathi, for every woman an entrepreneur, and therefore it is Rohini who is starting a business of her own, and it's a very simple business, which is basically that she buys ice cream and sells it, okay, to various school children, office crowd, and so on and so forth. And we are going to try and figure out for this particular business, how do we go about finding out the unit costs of this business. So there are various details involved, and we will go through that. And the first one is that she knows that she can sell uh, one scoop for 50 rupees. Now, this particular case was developed like maybe about a year ago. So it is possible that at that time I had made sure that the prices and everything conform to the business reality at that time in India. So I looked at various towns in India, not just big cities like Mumbai and all, but Pune and the smaller, etc. And I came up with some representative numbers, and that's what it is. But hopefully it is going to illustrate to you for your own situation, how will you determine the unit cost of your product. So here is a situation where, as the case says, the sales price of that one scoop is 50 rupees. Now we need to figure out what are the variable direct costs, variable and fixed, and indirect costs. And the direct costs are those that the variable direct costs are those which vary with every scoop. For example, that is ice cream. So if you have bought ice cream for somebody and you are going to scoop it and sell it, the cost of the ice cream is directly related to the number of scoops you sell. And here in this case, it is 11 rupees and 58 paisa. Okay, a cup is 60 paisa. So therefore, the total direct variable cost is 12 rupees 18 paise. Okay, and if you sell it for 50 rupees, you get a net contribution. Some people call it gross margin, some people call it contribution margin. Here I am calling it contribution, but it means the same thing. Okay, and the thing is that 1 liter of bulk ice cream costs Rohini 110 rupees. And if you are going to make 100 milliliter scoops, you should get 10 scoops per liter. But there is a 5% wastage. And because there is 5% wastage, she can only get 9.5 scoops. So therefore, the cost per scoop is going to be 110 divided by 9.5, which is 11 rupees and 58 cents. Plus cost of scoop is 60 paise. And therefore, the total amount, every time a scoop is sold, that is the direct cost, direct variable cost that she is incurring. and that is 12 rupees 18 paise. And therefore, the contribution each time she sells, that's the amount of money she makes. Okay. So that is the step one. The next step is to look at fixed direct costs. The direct cost, as per the case, it is going to be the person Vatsala that she has employed, and her job is to actually scoop the ice cream and give it to the customer. So that is directly related to the sale of the ice cream, and therefore, so per week cost is going to be, she gets like 10,000 rupees, okay, per month, 120,000 a year, and therefore per week it is going to be 2,769 paise per week. The direct cost of Rohini's own salary is going to be the scoops that she makes versus the rest of the amount that is meant in sort of the management of the business. So therefore, we need to separate Rohini's salary into, I'm trying to fit it into because I think by now we have to end by 10, in another 22 minutes. But we have to separate the salary that is variable and the salary that is a fixed cost. So this is what I'm doing here by saying that, okay, the direct cost of Rohini's salary is going to be 1,153 rupees and 85 cents. So that goes there. Plus the fuel cost. The fuel cost is direct cost, but it is fixed because she needs to actually run the refrigerated van all the time. Okay. If she doesn't, the ice cream she has in inventory melts. So therefore, she has to do that. Now, it is possible sometime, that is the risk part of what Ashwini was saying, that sometime there may be some problems and, the thing breaks down and things like that. There could be some loss related to that, but we can price that once we get through these kind of calculations. Now, fuel consumption is calculated 8-hour work day, which is about 15 liters of fuel. Plus, for the remaining 16 hours, you don't drive the van, you only run the refrigerator. That is 15 liters. So for 6 working days, she has got basically 30 liters per day, which is 180 liters. But for the day off, she is not driving. So the only consumption of fuel will be for the refrigerator, and that is going to be 22.5 liters. So therefore, the total fuel consumption for the week is going to be $202.50. Therefore, the cost of fuel is going to be 20,250 rupees. Now, the question arises as to why we do this on a weekly basis. Now, that is a homework assignment for all of you. And if you have questions, you can contact me later on and we can discuss this in detail. But anyway, the total direct fixed cost is going to be 23,711 rupees 50 cents. That's what is listed there. Okay. So therefore, okay, if you want to cover your total direct fixed cost, okay, you need to sell at least 626.96 or 627 scoops. Then you will generate enough contribution to break even. You will cover the fixed direct cost. That's what it means. Okay, so that is one use of this unit cost calculation. It will tell you how much do I need to sell. So as an entrepreneur, you need to figure out where should I direct my energies. It depends on this calculation. Should I be directing my energies in controlling costs? Should I be directing my energies into increasing revenues? Okay, so that I can sell more, and whatever approach you want to take, but these are the numbers that will help you do that. The next is indirect costs. Indirect costs are Rohini's own salary, which is 25,000 rupees per month. That is 300,000 rupees per year. So it comes to 5,679 rupees and 23 cents. But we already allocated a certain amount of her salary to the direct cost because she is also doing the scooping. So therefore, indirect cost amount is 4,615 rupees and 38 cents. Then the van cost her 400,000 rupees. Useful life of 5 years gives you an annual straight line depreciation of 80,000. Now there are different types of depreciation methods that are available, and they essentially depend on how much, whether you want the depreciation cash advantage to come in the beginning or later, etc., etc. I really can't cover that in a 30-minute session, but you can look it up, and if you send me a message, I can email, I can give you references for that. But the weekly depreciation is going to be 1,538 rupees and 46 cents, and that is that amount. Plus maintenance, monthly maintenance is 5,000, and therefore weekly maintenance is 1,153 rupees and 85 cents. However, it doesn't get paid every week, and that will become relevant in a few minutes when we go there. So total indirect costs that she incurs per week is going to be 7,307 rupees and 69 cents. So therefore total direct and indirect costs are 31,019 rupees and 23 cents, okay, per week. Now if you want to cover all of that stuff, not just the direct, variable, indirect, the variable cost, but indirect costs, fixed indirect cost, she needs to sell 820 scoops per week. If she does that, she's good. So that is the number here. So if she sells 820 scoops, their direct variable cost is 9,987 rupees and 60 cents. Fixed cost is 23,711 and 54. Indirect cost is 7,307 and 69. So the total cost is going to be 41,006 rupees and 83 cents. Now that gives you a unit cost, because these are all cost variables, of 50 rupees and 1 cent. So that one paisa. That 1 paisa is basically rounding error. And since she is able to sell 1 scoop for 50 rupees, that's where she is breaking down, and breaking even rather. Okay. The maximum capacity according to the case is 1,440 scoops that she can sell. And there, all these calculations, if you notice the direct fixed cost, indirect cost, all of them remain the same. The only thing that changes is the direct variable cost. And that gives you a unit cost of 33 rupees and 70 cents. The first thing to notice is that unit cost is not a constant number. Unit cost changes depending on your sales volume. And therefore, for the entrepreneur, it is necessary to determine that number, because the solution to profitability may depend on either controlling costs or increasing revenue, and so on and so forth. So if you want to increase revenue, there are some questions at the end of the case which talk about various possibilities that can be engaged into to figure out what solution one may be able to come up with. But with just unit costs, you can actually determine what the problem is with the business. If everything is going okay, you may start thinking in terms of how can I expand. But if it is not going okay, where does the problem lie and what do I need to do to solve the problem? So that's where you are. Now, let's go to how to build the financial statement. Why are financial statements important? Some of you may be familiar with this, so please bear with me and I apologize in advance. Okay, but there are three main types of financial statements: income statement, balance sheet, and cash flow statement. So income statement provides information about revenue, sales, expenses, and various measures of profit. And it tells you what is going on with the business over a certain period of time. So if it is an income statement done on a weekly basis, monthly basis, quarterly basis, it will tell you what did you do over the quarter. It's the same thing like, a few days ago you had this thing about the US economy that it grew 3.3% and things like that. So that is what happened over a period of time. But if there is an information like how much was the end of the quarter deficit, okay, or the indebtedness of the United States, that is something that is at that point in time. And that's what something that balance sheet tells you. It tells you what was happening at the end of a quarter or end of a week, end of a month or end of a year. So it's at a point in time. Now, cash flow statement also tells you the movement of cash over a period of time. That is quite different from what happens in income statement, and we will see that in literally a couple of minutes. Okay, so we are going to look at all of those. So let us say that Rohini started her business at the beginning of week 0 by putting in 5 lakhs of rupees of her own money into the business. As soon as she did that, this is how it looks. The cash flow statement inflows from Rohini's account 5 lakhs, and the balance, cash balance is 5 lakhs because she put in and that is the amount of money in the business. Income statement is blank because she has not yet incurred any expenses, nor had she sold any ice creams. So income statement is blank. But on the balance sheet, you say cash is 5 lakhs because that's what you put in, which gives her total assets of 5 lakhs. And the paid in capital from the owner's equity account is 5 lakhs. Total liabilities are 5 lakhs. So the balance sheet balances and total assets equal to total liabilities equal to 5 lakhs. Now let's move the business forward. During the first week, she does many things. The first thing she does is she goes and buys her van, which is 4 lakhs of rupees. So now out of that 5 lakhs, 4 lakhs is going to be spent. The cash is going out and that is included there. But then in order to start selling ice cream, she needs to buy ice cream worth 55,000 rupees. Then she needs to buy cups, 864, and she needs to buy fuel, 20,250. So if she adds all of that, her total assets are the same because all she did was to pay the cash and get the amount, get the inventory and van and etc. so on and so forth. Okay, but because she has herself and Vatsala, their wages become payable. The case tells us that she pays wages every 2 weeks. So at the end of first week, the wages are just accruing 8,076.92. Nothing has been paid yet. So therefore, it does not show up in the cash flow statement, but it shows up as a liability because she owes that money to herself as an employee and she owes it to Vatsala. So if you take that, this is the accumulated loss which is showing up in the income statement because the revenue, there's no ice cream sold, revenues are 0. And you find that the total assets are 5 lakhs, total liabilities are 5 lakhs, and the balance sheet balances perfectly. Now, the next thing. So, beginning of week 2, everything is in place. There is a van, there is fuel, ice cream, cups, and 2 employees. So, they start selling, let's say. And let's for now assume that they sell at capacity, 1,040 scoops, 1,440 scoops. We can change that assumption and calculate sensitivity analysis or whatever we want to do. But once we have the framework ready, all kinds of analysis can be done. So if they actually sell 50 scoops, you get 72,000 rupees. So therefore, income statement will show 72,000 rupees as revenues. Direct variable costs for each of these will be ice cream, cups in the income statement. So if they sell that ice cream, what it means is that the ice cream inventory is going to go down by that much. So therefore, new inventory will be the original one, which is 55,000 minus 16,675. So that is 38,324.8 is what is going to remain. At this point, as an entrepreneur, she needs to ask the question, is this enough for next week or do I need to buy more ice cream? Okay. It looks like with this, these numbers, she can wait at least for one more week. So I think as far as ice cream amount is okay, she's okay. But the cup inventory has gone to zero. So she needs to pay 864 rupees to replenish cup inventory, and she needs to buy fuel because she finished with whatever she had purchased. So that cash out will go out. So let's reflect that. So 72,000 rupees came in because she sold ice cream, but 21,114 rupees will go away because she has to buy 864 for cup and fuel for 20,250. The total is that. So therefore, the 23,886, you add 72, subtract that. So she now has a cash of 74,770 rupees, 772 rupees. And that cash is right there on the balance sheet. Okay. Ice cream inventory has gone down from 55,000 to whatever she sold, that is 38,324. And that amount is going to be exactly equal to the 55,000 minus the ice cream that she sold. That's that number, 16,675. So that's what remains. She did incur an expense to sell the ice cream of 864 rupees for the cups. Okay. But she replenished 864 by buying more cups. And that money is coming from here because we included it in 864. Once that money is there, it is going to bring down your cash by that much. But the cup inventory will go up exactly by that amount. Similarly, fuel is included there, but the fuel inventory went up. The fixed assets are 4 lakhs, which is the van, but you subtracted depreciation from it because the calculation we did, the weekly depreciation was that amount. So therefore, net fixed assets went down now because of the depreciation from 4 lakhs to 3 lakh, 98,000 and etc. But the total assets went up because she did some business, she sold. So there is fuel, there is labor, there is Rohini's salary, in the one that is not included in the direct fixed costs, plus depreciation, plus maintenance. But the maintenance has not been paid. It has just accrued. So it has reduced your profit. But since you didn't pay it, you will have to pay it at some point. So it is going to show up there. And then you do all these calculations, your balance sheet will balance 532,672.34 to 532.61. It will balance exactly. So when you are doing all this, you have to make sure that this profit and loss shows up here exactly. The cash from here shows up here exactly, and the balance sheet balances. Okay. So this is in some sense is called double entry accounting, which came into being when some merchants in Venice actually wondered as to how does this whole thing work. Because these merchants used to actually receive goods from the east and send them to the west. And they said, if my warehouse gets emptied, there is nothing in there. So I just sent goods. Does that mean that the value of my business has come down to zero? And then they came up with this concept of double entry accounting, when they said that when inventory goes out, accounts receivable come in. And that reflects the value of the business. But anyway, let's move on and let's refine this further. Okay. Now you say that, okay, at the end of week 2, we have to pay the wages, right? So we have accrued 2 weeks worth of wages, which are 16,153 and 84 cents, 84 paise. So that gets paid out. If it gets paid out, that gets reflected in outflows, which will reduce your cash. And that reduces from 74 to 58, and that is reduced cash. But your wages payable from the previous balance sheet that we had goes to zero. So this number comes down. That number comes down because the cash went down. Okay. And in the end, the total assets and total liabilities are identical. So that has to happen. Okay. The next, let's refine it even further. Because now we have to say that, okay, there are taxes that we need to pay. So this 23,441 is before tax. But there 3,841 rupees and 16 cents is the tax. But did you pay that tax? No. Typically, a business will pay that tax every quarter, every 3 months. So therefore, it becomes taxes payable. Okay. So no cash has changed, but taxes payable have gone up. But when taxes payable go up, your retained earnings, which previously were including the taxes, now you took some money out of here and made it into taxes payable, keeping the total assets and total liabilities identical. So that is the mechanics. Okay. So you can now, so these are the numbers. Okay. The contribution margin is 75.6%. So this business can generate profits at the contribution margin level. The pre-tax margin is 32.6%. It looks reasonably profitable. The net profit margin, that the post-tax profits of sales, is 24.4. That also looks pretty good. Return on investment is 3.4%. So now all of you are entrepreneurs. What do you think of this number? 3.4%. Is it good, bad? Does it motivate you to work hard on your business, or yes or no?
It's low.
Yeah. Somebody said something.
It needs to be compared with if I had put the money somewhere else, would I get more or less?
That number is pretty low, right?
Yeah.
The question is, why is it low? And I can give the answer because we're running out of time. The reason why it is low is because this is a highly capital intensive business. She has to put it she has to buy this van for 4 lakhs of rupees, So even if she sells at capacity, she's not going to generate that money, right? That is where the problem is. So she has to figure out a way of expanding. If there is any downtime whatsoever for a business, she needs to figure out. So therefore, in the case they talk about, various things like, can she go to school and can she sell ice cream in company cafeterias and this and that, etc. Because 3.4% is not going to excite any investor to put money into this business. It's just not enough. But everybody will be able, if you show them the numbers, they will be able to do this. But generally, if you do attract attention of some investors, VCs or whatever, they are going to look at this and they will actually help you out in business connections to say that, okay, we understand what is going on. If we put in money, we should do this. This is what you should do. Because at the end of the day, they also want to make money. But this 3.4% is not an exciting return at all. But you will not know that until you do this analysis. You are going to look at 75.6% and you are going to say, aha, I am doing great. But you are not doing great because you have to pay upfront 4 lakhs. And that's where the problem is. But nevertheless, so this is, I hope this has given you some idea about how to think in those terms and how to use the numbers to actually guide your actions. And that is, I think, I think Devadatta actually gives us 2 minutes and I have gone to 3.
No, that's fine. I think you can go ahead,
That's fine.
Dr. No, because I think you have explained it quite well, very detailed. I think if we can even continue for 5-10 minutes if people have any
Yeah.
questions.
But I
Because,
think I use that time to answer the question.
No. In case we can still use
Yeah.
5-10 more minutes for Q&A, because this is
Yeah.
very important topic and it is quite complex for most of the startup founders to understand.
Yeah, but if they want to just digest it and read it and think like that, and I'm happy to spend some more time later.
Yeah.
Because I can see
And
this is a lot of material, I mean, people can't just figure it out, on the spur of the moment, You see what I'm saying? And it is also, they are probably thinking in terms of how does it affect my business, right? And it's not, yeah.
No, it is very nicely explained week on week how that the balance sheet changes. So, what we can do is, Dr. Bhandari, we can have a recap of this session within 10 minutes of the next week also. And depends on how we have Ashwin's and accounting session. And so that there is a continuity.
Sure. Yeah,
Sure,
we
we
can do
can do
that.
that.
Yeah.
There is also one more issue, when I did this for this every woman entrepreneur and thing like that, they were like really early startups. And they were so open with each other. They were giving each other advice and did you think of this? Did you think of that? But I don't know what this audience is, that's what I was in our earlier private
Yeah,
conversation.
this audience
Because you
is
see,
like
people may be more advanced and they may not want to tell what's going on. You see what I mean, in a public forum. So we'll have to figure
while
out
they are in
some other
advanced
way.
stage, while Dr. Prafulla, they are in advanced stage of their startup. Most of the startup founders find financial and accounting and understanding to this level, basic level, is lacking to a large extent. What my experience is, not all of them from this cohort may have that situation, but at least I'm sure more than 50-60% still understood what you are saying, and it's still they might still find it little complex. That's why they normally outsource this function. But until you understand it as a startup founder, I think you need to understand how it changes, how the balance changes, economics works. That's why it's
There
important.
is also another thing, because many of these people will actually hire an accountant.
Right.
See, but an accountant is not a managerial accountant. You see, if the accountant does something, the entrepreneur needs to understand what exactly he's doing. Or if he asks some questions, he or she asks questions, what does that question mean? And that is what entrepreneur does, I mean, because they have to relate all that to business context. Whereas an accountant is going to say, okay, how can I minimize taxes or something like that, and that's not the whole picture.
So there is a question on the chat. A lot of times we get asked question of CLV and CAC, customer lifetime value and customer acquisition cost. It will be great if you can touch upon it. I think is Ashwin going to cover that in the next session?
Yeah, I think Ashwin will cover, but that's why, if you remember, I sent him a message saying that he and I need to debrief
Hmm.
because he
Yeah,
needs
the
to know
unit
what
economics is,
happened, and because he's now traveling, so he
yeah, I
can
know that.
attend this, So he and I, we need to talk. So we probably maybe he's in India, so if I talk to him like Tuesday morning, it will be Tuesday
Sure,
evening,
that's fine. Next week we
and
can
we'll
cover this.
connect somehow, yeah.
Yeah, yeah. No, I think we should
That
cover
will
this
be great. Yeah,
because,
sure.
yeah, we should cover this because normally, in a startup concept, the unit economics plays a very important role. And just for all the founders here, uh, while next week we'll try to cover this topic in detail. CAC is like basically all the cost that to acquire your customer, which is sales, marketing, all that cost, and the lead time to acquire the customer. And then CLV is a lifetime value, is a net present value, what Dr. Kale also just wrote, is a revenue throughout the customer journey, like kind of your customer remains with you, okay, and the number of times he or she buys your solution. So that's a total value of the revenue. And
Right.
if your customer acquisition cost is more than the customer lifetime value, naturally you are in a loss making business.
Correct,
Okay.
yes.
And if your customer acquisition cost is less than your lifetime value that you can generate out of that customer, naturally you are in a profit making business.
Right.
So
Yeah.
these are at a high level thing, but I'm sure Ashwin and Dr. Prafulla will touch upon it in detail next week.
Sure, Vijay.
Okay, thank you, Prafulla ji. I think this was a great presentation, and I can see in the chat people already appreciating that. So really appreciate that, and I also want to thank you for pulling in this today because it would have been very hard for all three of you to give justice to your topics in the next week's session. So we tried to kind of separate it out so that there's more time.
Okay.
Thank you. So with that, unless there are any quick questions, we can move to breakout sessions. And both the presenters, you are welcome to stay in the breakout sessions, but if there is a time crunch or something, it's really optional for you. You can join any breakout room. Typically in the breakout sessions, we do discuss any questions from today's session. But we also spend time in discussing assignments from the previous week's session. Previous week, we discussed about IP. That was a session that I had presented. So there would be a combination of questions based on today's session and the next session. So you're welcome to join any breakout room, and that will give you idea to what kind of questions come up there.
So we choose the breakout room, or you will assign us?
You can choose. We usually assign it to participants, but today
So please assign. I will go wherever you send me.
Okay, Dev, in that case, yeah,
Sure.
please go ahead and assign to the
Okay.
presenters, okay?
Sure. Yeah.
And
Thank you.
Prafulla ji, please feel free to change the rooms as well, because while you are there, it will be great if there are questions from today's session that you can also address it there, because there is more time, one-on-one time in that
Sure.
session.
And there is a spreadsheet which does all the calculations. And there is also this, I only share the case. But if people want to have this information, the PowerPoint as well as the spreadsheet, please, I can send it to you and you can send it to them.
Sure. We'll share it on
There
Slack.
is nothing secret in here, as
Yeah.
you can see,
Yeah.
It is just some very basic accounting concepts.
Actually, that material is always helpful because that gives more time to digest the material for all the
Sure.
cohort companies.
So I'll send it to you and Devadatta as I did before.
Sure. Yes,
Okay,
yes,
I'll
please.
do that.
Yeah.
Yeah.
Thank you. So Dev, you can assign breakout rooms to the to the presenters as well.
Okay.
And just feel free to change the breakout rooms as you want. You're most
Okay.
welcome anywhere.
Shall I stop my share?
Yes, please.
Yes,
Okay.
please.
Okay, Sanjay ji, this is Sucheta here.
Hi,
We
Sucheta
just
ji. Yeah.
Hi. So I will just be joining breakout rooms, tell my mentees, and I will exit because I need to go for some other things, so I won't be able to give time.
Okay,
I'll
no
just
problem.
speak to my mentees and fix the time when we can meet otherwise and check their assignment.
Sure.
And then I will exit.
Okay, no problem.
Okay, thank you.